All right, so officially starting module 2, we're going to cover one of the most important ratios in commercial banking and all of finance. There's some variation of this ratio. So honestly, the debt service coverage ratio, DSCR, or the fixed charge coverage ratio, FCCR, sometimes they're used interchangeably, and I'll kind of explain why. But if I can, let's see here, if I can guide your attention here to the simply part, all it is a ratio between cash flow in the numerator over debt obligations or some kind of obligations in the denominator. That's all this ratio is. It's to measure whether you have enough cash flow. Sometimes you have to adjust it, sometimes you don't, but whether you have enough cash flow to cover all the things you have to pay for. Of course, that includes the debt obligations like principal and interest that you owe the bank. If the bank decides to lend a company money, we're calculating whether that company has the capacity to repay us. Okay, so let's take a look at the difference between DSCR and FCCR. So DSCR, or debt service coverage ratio, is basically it measures the company's ability to cover their debt obligations. So that's usually just with respect to principal and interest. And then FCCR, fixed charge coverage ratio, measures a company's ability to cover all fixed charges. So the difference between fixed charges and just debt, well, if you look down here, for DSCR, the debt, it could just be with respect to specific debt. For example, like you can calculate the cash flow over something that you might be offering a company, right? You might not at that point consider some of the other debt they have, some of the other fixed obligations they have that might not be debt. For example, if they have lease payments, that's a very common one. If they're borrowing some kind of equipment, machinery, automobile, and they have lease payment obligations. Lease payments are not always classified as debt, but they are, they have to pay it every year. So that is not really debt. It won't be counted in the debt service usually, but it will be included in FCCR. Okay, so all debt obligations, some specific debt obligations, and fixed charge coverage expands to even greater than just the definition of debt. It could also include, in some cases, rents. Right here, you see how the formula on top is exactly the same, but on the bottom for DSCR it's just principal and interest. For the bottom, it kind of modifies that. It says cash interest and then all mandatory debt repayments. So stuff like leases, if it's kind of like a similar to debt. Sometimes there's something called shareholder loans where like the owner of the company lends their money to the company itself. It's kind of a weird structure where then the company has to pay its own owner back because the owner is the shareholder, right? So in those cases, the owner's obviously not charging his own company interest, but the company might still have to repay the owner every year, every 2 years, whatever the case is. And that is considered a mandatory debt repayment, assuming it's mandatory, right? And then rents is something that, like if the company is leasing the property they're in, sometimes, not often, we also include rents in the definition of FCCR. The one caveat here that I didn't really specify is if you include rents as like a denominator, something that you have to divide by, you technically also have to add it to the numerator. Okay, when you calculate EBITDA here, rents, if you include rents, you have to add it to EBITDA, and then you are using not EBITDA, but you are using EBITDA with an R at the end. EBITDA and then an R. The R stands for rents, and that's because if you think about it, if we're measuring a company's capacity to repay rents, right? If you're dividing it on the bottom, we have to add it in the top. So that's something that like it's the same idea as to why we add interest on top and then divide it on bottom. So if you think about it, if we want to measure a company's capacity to pay interest, capacity to pay, rents, you have to like obviously add back any interest that it's paying already, like any of the interest expense or rent expense. You have to add it back to the cash flow, because if you want to measure a company's capacity to pay it, you have to know the cash flow before they paid any interest, any rents. Okay, so hope that makes sense. I know I went through it a little bit fast, but of course reach out if you have questions about any of this. All right, so let's go right on to a practical example. We're going to walk through this together. So I've presented a new income statement. I know it has maybe some of the same information, but the numbers are different, okay, for this practical example. And then we have some information on the right. So here's the ask, okay? Here's the ask. So a client or a prospective client is coming to us and they're asking for a $2 million loan. They want to amortize it over a term of 10 years, which means they want to repay the $2 million in over 10 years. And then let's just say that we decide that the right interest rate to charge them is 5%. Now, how do we determine the right interest rate to charge them? Well, we look at usually like for all banks, we look at their financial statements, and then based on their financial statements, we figure out whether the company's performing well or not performing well. And then based on that, we would adjust the interest rate we charge them. There's usually, it's not something you have to figure out yourself. It's oftentimes there's a software that, or like some kind of proprietary system or pricing system that the banks will use to make sure they're compensated accordingly versus the risk that they're taking to lend money to a company. Okay. And then on the bottom side here, we're going to just give you the on-finance capex and distribution numbers. In module 1, we talked about how you can calculate them, but for the sake of like keeping it to the point, we're just going to give you these numbers. Sometimes, like oftentimes, you'll have to calculate them yourself using the balance sheet and income statement or cash flow statement. Okay. And then for simplicity, we're just going to say that cash taxes is equal to the income tax expense, which is right here. Okay. IT expense, income tax expense. We're going to start off by calculating DSCR. I just noticed that I wrote DCCR here. That's not DCCR. That should be DSCR. Whoops. Debt service coverage ratio. Okay. So let's walk through this together. First step is calculating EBITDA. I think this should be familiar for most of you. If not, then go back to revisit the EBITDA video. But the way that I would approach this would be starting from the earnings before taxes line and then adding back interest and amortization. Pretty straightforward, right? That basically gets you an EBITDA of $625,000. Okay, so that's pretty simple. And then we have been given, shaded in orange, the unfinanced capex. We're given the distributions. And then cash taxes is just equal to this right here, right? For 44,250, because we're assuming that it's just equal to in income tax expense. So the only thing left to figure out based on the formula that we just covered is the denominator, which comprises the principal and interest for the debt obligations. So to calculate principal, I want to draw your attention to this line here. Okay, to calculate principal, you know how they're asking for a $2 million loan and they want a term of 10 years. So in order to pay off the loan in 10 years, just for the sake of simplicity, right? It's 2 million divided by 10 years. So they have to pay on an annual basis $200,000 a year in principal in order to pay it all off over 10 years. I hope that makes sense. It's just straight arithmetic. And then in terms of interest, let's say they want to take this loan, right? So we're only going to calculate it for the first year because going forward, as they pay the balance of the loan down, the interest expense should get lower and lower. If you think about it, after the first year they pay off 200,000, then the balance will be 1.8 million. The 1.8 million, the interest on 1.8 million is always going to be lower, right? Every year as they pay off more principal, the interest expense decreases. But in order for us to just keep it simple, and oftentimes this is what we'll do when we do analysis, is let's just assume that this full $2 million, like we just multiply the 5% interest by the 2 million. Even though this is kind of very conservative, in reality, just keep in mind that in reality, for the first year, the average balance of the loan isn't actually 2 million. It's actually 1.9 million because at the end of the year, they're going to pay it down to 1.8 million because it's usually a monthly payment. So in the beginning, when you give them the loan, it's 2 million at the start of the year. Let's assume that at the start of the year is 2 million. At the end of the year, it's going to be 1.8 million. So actually, the average loan balance is 1.9 million, right? So we should actually be multiplying 5% by 1.9 million. But just to keep it simple, let's just multiply 2 million by 5% to get $100,000 interest. Very straightforward, right? So now we know that the total principal and interest obligations is 200,000, 100,000, so 300,000 per year if we're testing for whether this deal is going to work. Okay, so we have 300,000. And then take a look at this down here. This is putting everything together. We have EBITDA minus the unfinanced capex minus the distributions minus the cash taxes. Okay, so that's the numerator. This stuff is cash flows. Okay, cash flow. That's really ugly, but you know what I'm getting at. Cash flows. And then the bottom, like we said, is the 300,000 here for principal and interest. So once you do that division, all that adding and dividing, you end up with 1.17 times. Okay, so what that means is that with the company's cash flows, they can actually cover over 1 time, so 1.17 times the total debt obligations. Okay, and usually, as a rule of thumb, sometimes the banks usually want 1.20 times or 1.25 times coverage. The reason is because they want a little bit of a margin of safety so that just in case the company doesn't perform as well as they do when they apply for the loan, the bank still has some room, some wiggle room to, let's say, go back and say, hey, the situation is deteriorating, we're afraid, like it gives them basically a margin of safety, a little buffer, if you will, to kind of figure out the situation and make sure that they can either work with the company to get back on track or get back above the threshold 1.2 or 1.25, or they can decide, hey, do we what things do we start limiting? Like, do we start limiting their distributions? The 50,000 distributions here. That's basically like the company taking out an amount of money for, whatever purpose. We say, okay, no more distributions, right? If the ratio starts to fall, et cetera, et cetera, et cetera, right? Like, so this really helps. The debt service coverage ratio is the most important one. In commercial banking, at least, it helps you kind of get a good gauge on whether the company is able to continue to repay the loan that you as the bank has issued to them, and including interest, of course. That's where you profit. All right, so now let's look at the more enhanced version, which is FCCR. Again, this is going to be a little bit more, complex. Like the shaded in blue here, the rent. Now that we're adding rent to it, like keep in mind what I said earlier, like we usually don't add rent into the FCCR, but you'll see it's very similar to DSCR. Like oftentimes it's used interchangeably. Like when you do an analysis or you're working for the bank and you're calculating, like let's say they put in their credit that they're calculating for FCCR, but in reality, they're doing the same calculation as the one we did on the previous slide, the DSCR. So just keep in mind sometimes it's used interchangeably and very rarely do they put rent into the equation. But I just want to, kind of preface that it can be put into the equation because fixed charge coverage really what it means is it's everything that's relevant, every fixed charge, everything that the company has to pay on a regular basis, we're incorporating it into the equation. Okay. So again, with EBITDA, we're calculating EBITDA now because we're incorporating rent. So it's going to be the same thing starting from EBT. You're adding back amortization and interest to get EBITDA, but then we're also adding back rent. You see that 300,000. So now we have, instead of an EBITDA of 625,000, we have 925,000 for EBITDA. Okay. So after that, it's very, very similar. The principal and interest, it doesn't change. We have the same exact methodology to calculate it as we just described. But there is one change here. So now, this isn't, obviously, you're going to find this information on the cash flow statement or balance sheet, but I'm just going to give it to you here that let's just say that this company has a shareholder loan repayment where they have to pay $50,000 in principal a year. And then they don't have to pay any interest because usually, when the company owes the shareholder or the owner money, the owner's not going to charge his own company interest. Okay, so the shareholder loans are usually interest free. So let's just assume that they have to pay this $50,000 a year back to the shareholder that loaned the company money. And then let's just say that the shareholder loan has a balance of $1 million. This doesn't really matter for now, but let's just keep in mind we have this extra information. It's going to come in handy later. Okay, so what we're going to do now for FCCR is we're going to take the, so this right here, I made a small mistake here. This shouldn't be 625,000. It's actually 925,000. The calculation should still be right though. I think I just didn't really write in the right number here, but this EBITDA is 925,000. You're going to still subtract the unfinanced capex here, the distributions, and then the cash taxes. Everything else is exactly the same on top, and then on the bottom everything is the same except now you notice you're also adding in the principal payment for the shareholder loan, because remember the formula a couple slides ago, it's all mandatory debt repayments. So if we're saying that they have this random shareholder loan that they're on the hook for, we have to add it to the bottom as well. Okay, and then we're also adding in rent to the bottom. So once you do all this math, usually we're just plugging all this stuff into Excel, into a few cells, and then we get an FCCR of 1 times. So that's just a straight, like, numerator can cover the denominator. So FCCR, one thing about FCCR is if it's different from DSCR, it's always going to be lower than DSCR because it incorporates more things. But then because it's a more strict ratio, because it incorporates everything, the banks usually only require an FCCR of maybe 1 times to 1.1 times instead of 1.2 times because it is a more stringent ratio because it covers everything, right? And yeah, so really, like I said, there's not too much difference. I know when I first heard the terms DSCR, FCCR, I'm like, oh my God, like there's all these different formulas, but they're really the same formula. You're just saying like DSCR is the standard formula, and then FCCR is like you're saying, okay, we're gonna incorporate everything that's relevant, everything that the company has to pay for in the denominator, and rent sometimes in the numerator and denominator, but usually not. Usually the top is exactly the same as DSCR. Okay, so that should make it simpler, hopefully. Okay, so I'm also going to throw in this iteration of the leverage ratio because it's something that we test, the only thing that really comes up in commercial banking. So I thought it might be useful to go over. So this leverage ratio specifically deals with cash flow loans, which means that we're lending money to a company based solely on their cash flows. Okay, based on their EBITDA. You see that? So this is a adjusted EBITDA. This is a finalized normalized EBITDA, by the way. So oftentimes there's a bunch of adjustments to it. It's not just you take the raw form of EBITDA and then you know plus minus. You see on this income statement, you see the losses based on disposal, losses or gains on disposal of assets, the foreign exchange. So those would normally get adjusted to the EBITDA because they're not recurring items. These are like I said in earlier videos, like not really something that happens on a recurring basis. And then it's a really simple calculation. On top, you're looking at total debt. So what I'm doing here is I'm adding the 2 million that we're contemplating loaning to this company, and we're also adding in, like I said earlier, the $1 million shareholder loan that they owe. And we're going to consider that as debt as well because there's a principal payment that's mandatory. So then we're going to divide that by, I guess 925,000 might not be the right number actually. It's usually like the EBITDA number, but I think you might have to adjust it for these things as well. So this number is actually not it's not might not be accurate. Let's just assume that we're not adjusting for this stuff and we're just using EBITDA. It's not, we usually don't use EBITDA. So then it's 3 million divided by 625,000. So it's actually not 3.24 times, it's actually 4.8 times. So this leverage ratio shows that there's 4.8 times the debt versus the company's EBITDA, which means that assuming all of their EBITDA is applied to debt, it'll take them 4.8 years to pay off the total debt. But I guess we don't really think about it that way. Actually, we think about it more like in terms of like how leveraged the company is versus their EBITDA. We want this to be as low as possible. We don't want to have the company borrow money that's multiple times higher than their EBITDA. So usually I would say that 4 to 5 times is like the maximum. So 4.8 is actually quite high for leverage. We usually want it to be lower than this. So we're usually living in the space between 3 to 4 times for leverage. Okay, this is some more advanced tidbit, but it's very simple. Like this is just some stuff that comes with experience, but hopefully, it helps you out when you're talking to hiring managers when you're applying for the commercial banking role, or maybe even like investment banking or other capital market corporate finance roles, because this leverage ratio and EBITDA, etc., it's relevant for all areas of corporate business banking, etc., that kind of finance. Okay, hope this helps, and yeah, reach out if you have any questions.